Brad Williams, Frugal Finance, duration gap hedging. Duration gap hedging is a strategy companies use to manage their risk when it comes to changes in interest rates. Imagine a company, let's call it FSF, has investments in debt and wants to protect itself from interest rate changes affecting these. First, FSF looks at its investments in debt separately. It uses financial tools called swaps to balance out the risk. For example, if FSF has investments where it pays a fixed interest rate, it might use a swap to balance that with another investment where it receives a fixed interest rate. Then FSF looks at its overall financial situation. It calculates something called the duration gap, which shows how sensitive its investments and debts are to changes in interest rates. If FSF investments are more sensitive than its debt, it means it's at risk if interest rates go up. To protect itself, FSF can use swaps again, but this time to adjust its overall risk level. If it wants to reduce its risk but not eliminate it entirely, it can set a target for how sensitive it wants to be to interest rate changes. Previously, we showed how to eliminate the interest rate risk in the asset liability portfolio separately. As we saw, the assets required a pay fixed swap with a notional principal of $118 million, and the liability portfolio required a received fixed swap with a notional principal of $46 million. These two swaps are partially offsetting. Combined, the two swaps really equal a pay fixed swap with a notional principal of $118 million minus $46 million equals $72.1 million. This section shows how to reach the same solution using an integrated approach to the entire risk position of FSF. As we noted, for FSF, the value of the asset is $155 million with a duration of 3.9 years, while the value of liabilities is $139 million with a duration of 1.7 years. The difference in duration is 2.28 years, but the assets exceed the liabilities by the net worth of the firm. We need an integrated measure of the duration difference or duration gap between the assets and liabilities that reflect the difference in market value between the assets and liabilities. This measure is called the duration gap, DG, which is defined as DG equals DA minus total liabilities divided by total assets times DL. The ratio of total liabilities to total assets act as a scale factor to reflect the difference in market value between the asset and liabilities. For FSF, the duration gap is as follows. DG is equal 3.92 times 139.9. Divide this by 155 times 1.702 gives us 239. The duration gap is greater than the difference in durations because the market value of the asset exceeds the market value of the liabilities. Because the duration gap embraces both the assets and liabilities and reflects the difference in market value between the two, it summarizes the entire risk portion of the firm. Because the duration gap of FSF is 2.39, the entire firm has an interest rate risk that behave like a long position in a bond with a duration of 2.39 years. To hedge the entire value of the firm, FSF could use a pay fixed swap to set the duration gap of the entire firm, including the swap, so that it equals zero. Using the duration gap that we've just computed and our sample pay fixed swap, we have 239, 155 minus 5.5 equals 0. Solving for MVH, 2.39 times 155, divide this by 5.15 gives us 72 million. MVH for hedging the entire firm is 72.3 million in a pay fixed swap. This is the same result that we found by hedging the asset liability with a pay fixed swap and the liability portfolio with the received swap and floating the offset position that were created. Brad Williams, Frugal Finance. Thanks for watching.